Hello, I'm Victor Cuevas with Victor for Advice. I'm a financial consultant and an infinite banking practitioner. There's a financial concept that's so powerful that if you'll learn it and embrace it, man, it will change your financial life. It will truly create financial prosperity for you and your family. The concept is interest versus volume of interest. Interest versus volume of interest. Now, I've created a video and a PowerPoint presentation that explains the concept in detail. After you've watched the presentation, call me as soon as possible or email me, and let's see if we can get it going in your life. I'm Victor Cuevas, Victor for Advice. God bless you, and I hope to be talking to you soon.
Let's see how this volume of interest looks like as opposed to interest rate using loan calculators. Now you can go to bankrate.com, access this anytime you want. But here we have a mortgage calculator, and let's put in a $150,000 mortgage. Okay, and you see here it's for 30 years and 360 months. Going rate right now is about 4.25%. Now bear in mind these are historically low interest rates, and you probably won't see them this low for a long time. They're going to go up. So, but we're going to use this 4.25%. And let's calculate. And we see that the monthly mortgage payment, principal and interest, is $737.91. I wouldn't include any insurance. $37.91. Now, right now you're thinking, hey, I've got a great mortgage rate, 4.25%. My payment's only $737.91. But let's go ahead and check the amortization table. I'll click on here. Let's scroll down, and that table is coming up. And you see here in the first month, March 2014, we have that payment of $737.91. Principal is only $206.66. Interest is $531.25. Total interest is $531.25, and here's the balance over here, $149,793.34. This column here is total interest paid month by month for that whole time. So we're going to scroll down here and keep going for 30 years, right? We're going to get to the bottom. February 2014, this note is paid off, and you see right here, total interest paid over a 30-year time span is $115,647.54. I'm writing these down because we're going to summarize this at the end. So over that period, a $150,000 note, you end up paying $115,000 and some change in interest. Now bear in mind, how many people actually pay on the same mortgage for 30 years? What happens is that around the 5-year mark, we refinance. Or maybe you buy a new house and you get a new mortgage and you start all over again. So the figures that I'm going to summarize for you at the end are going to be conservative compared to this. And remember, this doesn't include rolling over the closing costs. Most of the time we roll on the closing costs, which adds to the 150, but just let's say we have the closing costs in here. All right, so that's the mortgage. Let's go on now to credit card. So let's suppose we have a $10,000 balance on a credit card. Not unusual nowadays to have that kind of balance. A lot of people have $20,000, $30,000, $40,000 in credit card debt. If we look over here, these are the national averages. Let's look at the national average for cashback cards, 16.34. It's going to change this to 16.34. 34. Minimum payment at 4%. And let's just calculate this. We have a monthly payment of $400. It's going to take 153 months to pay off, and your payments are going to be $15,054. Okay, so you can see right there that you've borrowed $10,000. You have $10,000 on this credit card. If you were just to pay the minimum payments until it's paid off, you'll be paying an extra $5,000 and $54.07. So that's based on a $10,000 balance on your credit cards. I think you're kind of getting the idea so far, but let's leave that there. Now, just another thought here. How many people, well, what usually happens is you have a $10,000 balance. You pay this down to maybe $2,000 or $3,000 if you're lucky, and then you run it back up again. Maybe you'll end up paying it off. You run it back up again, and that's just one credit card. Many families have 5, 6, 7, 8 credit cards. A lot of those credit cards, if not all of them, have balances on them. So you can see that basically you go your whole life and you always have some kind of balances going on credit cards. But we're just dealing with one credit card here for the example. Now let's go to an automobile calculator. And let's say you have a $20,000 auto loan. And I'm going to put 5 years here, 60 months. And the interest rate over here right now are very low. National averages, 60 month is 2.51. So I'm going to go ahead and put 2.51 here. Now again, these are historically very low rates. There'll be a time in the future, maybe 4, 5, 6 years down the road, where your auto loans are going to be 5, 6, 7%. But we're going to use current interest rates, 2.51. Let's calculate and make sure. And we have a monthly payment of $355.05. Let's do the amortization table on this. Computer's kind of erratic when I'm recording on it. And here we have the amortization schedule. And remember, just to give you an example, the first payment's March 2014. Payment is $355.04. Principal is $313.20. You got $41 going into interest and some change. This is the grand total of all the interest. You take it all the way down to the end. And your total interest paid is $1,302.13. And that was on a $20,000 note. Okay. Make sure we got this right. 20,000, 5 years, 60 months, and it's only 2.51, real cheap. And we ended up paying $1,302 in interest. Okay, now what I'm going to do is I'm going to summarize this on the next section, and there's when the volume of interest is really going to hit you. Interest rate versus volume of interest. I showed you a video where you saw 3 different loans: a mortgage, a car loan, and a credit card. And there you saw the principal amount that was owed on each one, the interest rate, and the amount of interest you paid over the term of those loans. Now, In this next presentation, I want to bring it all together and pull the curtain away from this mystery about volume of interest. Okay, here's a review of the three loans. We had a mortgage, credit card, and an automobile. The mortgage had an interest rate of 4.25, a loan amount of $150,000 that was going to be paid over 30 years. After it's all said and done, you will have paid total interest of $115,674.54. $115,000 and plus is 77.10% of the principal amount of $150,000. That's the volume of interest. That's 77.1%. Yes, you had a low interest rate of 4.25%, but what did you really pay? 77.10%. That was the volume of interest. That's the figure that you need to concentrate on. The credit card, 16.35%. You have a balance of $10,000. If you paid the minimum payment all the way until that credit card was paid off, you will have paid $5,054.07 of interest on that $10,000. That's 50.5% total interest volume. Are you getting the picture, folks? Automobile loan, 2.51%. We have a 20-year, $20,000 note paid over 5 years, and then in the 5 years you would have paid $1,302.13 of total interest. That's a 6.5% total interest volume. Now look at the principal amount of the three. It's $180,000, and then look at the total interest paid, $122,003.74. That's a total interest volume of 134.1%. Now there's two ways to look at it. You have a total amount owed of $180,000 on three loans. You paid a total of $122,003.74 of interest going full term on each loan. That's a total volume of interest of 67.7%. Or if you took it by each loan and averaged it out, it would be an average of 44.7% per loan of interest volume. So it was $122,003.74 total interest on just those three loans. Either way you look at it, folks, it's a whole lot of money. Now consider that the average family rarely pays off an auto loan. They trade it in before the car is paid off. That increases the volume to 8% or more. So most families, every 3 or 4 years, they want to trade in. That interest volume really adds up. Consider multiple credit cards that never get paid off. I mean, the average family has 5 to 10 credit cards. They're always carrying balances the whole life, carrying balances on credit cards. You've been caught in the trap of debt. Consider the average family will have multiple mortgages throughout life. As of 2010, 41% of retirees aged 65 to 74 still have a mortgage, and that's increasing. Don't let low interest rates keep you in a mortgage for life. Mortgage rates are historically low. They're going up, and they will be up there again someday. Consider this doesn't include loans for furniture, boats, motorcycles, jet skis, college loans, timeshares, second homes, etc., etc. I'm getting a headache thinking about it. Most families at any one time will have multiple loans. They'll have that furniture loan going, and their auto loan, and maybe college loans, and let's go out and get some jet skis or a boat. It can be crazy, folks. Just think about it. How many hundreds of thousands of dollars will your family pay on interest over your lifetime? Will you retire with debt? Will this be you in retirement wondering, how did this happen. So, if your family pays, let's say $400,000 of interest over a 40 or 50 year period, year in and year out, and let's say you could earn interest on that money, year in and year out, like maybe 4 or 5%, then how much potential wealth are you giving up to interest? $1 million? Well, let's see. $8,000 a year of interest paid each year for 40 years equals $320,000. That's a lowball estimate of what an average middle-class family will pay in interest on debt over a lifetime. Instead, if that went into a savings account, earning just 5% a year over that same 40 years, you'd have $1,043,710. That's a lot of money. Think of all that wealth gone from the family. Yet statistics tell us most families retire with less than $100,000 in savings. That's pretty scary. Here's what we all need to think about. Most families could retire very well off if they understood how to stop paying interest to the banks and lending institutions and start paying that interest to themselves. Let's think about interest. Those who understand it, collect it. Those who don't, pay it. My friends, that's the power of the infinite banking concept. Create your own bank and pay that interest to yourself. You be the collector of interest. Infinite banking concepts. I'm an authorized practitioner, and I can help you and your family set up your bank. With infinite banking, you can create wealth year in and year out while still financing your life. It's called financing yourself to wealth. When you retire, instead of retiring in debt, you retire in wealth. You like that? It's a new slogan I just made up. Retire in wealth, not in debt. Honestly, I just thought about that as I was writing this. But the cool thing is, that wealth that you create with your family bank, it's tax-free. Your bank can pay you a tax-free passive income for life, guaranteed. That's very cool. Just about anyone can put into place their own family bank using the infinite banking concept. It's just a matter of calling me for a consultation to see how it can work for you and your family. You can get out of debt, folks. All of your debt, including your mortgage, in 10 years or less, and have tens of thousands of dollars in your bank after you're done. For most families, that's $50,000 to $100,000 in your bank over that 10-year period accumulated, tax-free. Then you don't have to borrow from anyone else again. You borrow from your bank for the rest of your life and retire with tax-free wealth plus a lifetime income. Now, why is tax-free wealth and tax-free income important? Just look at this image. Need I say more? Your next step, immediately go to Amazon.com and buy Becoming Your Own Banker by Nelson Nash. I believe you can afford $15. It's only 100 pages long. You can read it in 1 or 2 days. After ordering the book, call me right away for a consultation. Everyone I work with must eventually read the book. Financial education is the key to financial prosperity. I can't emphasize that enough. It starts with this book. So take action now. The infinite banking concept applies to people of all ages, whether you're currently in debt or not. If you're debt-free, would you like to convert your future taxable income to tax-free income? Infinite banking can accomplish that. How about leaving a tax-free legacy to your grandchildren and setting up their banks so they don't have to live a life as a slave to the lender? And parents, you can do the same for your children. Business owners and the self-employed, wow, does infinite banking work well for you? Infinite banking for business. Check it out on my website, Victor for Advice, dedicated to freeing you from the bondage of lifelong debt and committed to helping you create your own private bank using the principles of the infinite banking concept. Own your life. Don't rent it. Live debt free and retire tax free. Retire in wealth, not in debt. Visit my website at www.victorforadvice.com. Hope to hear from you soon.